So my second choice is they do the same process.
All right, let's get started. I'm getting ready to go through this presentation. I've given this presentation to a lot of different groups, and every time I give it, it's a little bit different. Although I talk about the same 10 points, there's always people in the audience that starts asking questions, so I get to go through pretty much anything. And the key thing, this came about because I kept talking to a lot of people, and it's like there are simple strategies that a lot of people just don't understand, and this is a way that you can put together your tax plan. And so I go through some of the basic stuff that you need to know. Now, if you want to get a copy of these slides, and I know they're a bit hard to see, but you guys in the back, you can text the word investor to this number, 985-244-3944, and you'll get the slides in your email. And then also, if you want to sign up for my newsletter, I'll give you an option to do that. And then this will be on the bottom of every slide in this, but of course, in the back, you probably can't see it. And at the end, I'll show it to you again. So taxes are one of the largest expenses for real estate investors. In fact, for any business owner. The average tax rate for most Americans is around 30%. That's combined federal, state, Social Security, and if you're in real estate, you're a business owner as well. Some of the clients I talk to don't realize they actually own a business, but once you buy a house and you're a landlord, you're running a business, and you may not be aware of that. And so what happens is, depending on the type of business you're in, you may actually be paying additional taxes, which are called self-employment taxes, Social Security, and Medicare taxes. And I call this the sell tax. Congress talks about changing the income tax rate and all the stuff that they do. They don't touch this one because it's bringing in way too much money. And you know, back when Al Gore was running for president, they were talking about the Social Security lockbox and putting it aside. There is no money saved up anywhere. Congress spends it as fast as it comes in, but it's a big cash flow stream for it. But when you're an employee, you have Social Security and Medicare taxes deducted from your check. But when you're the business owner, you have to pay both halves, and then the employer pays the second half. The employee pays one of it. But if you own the company, you pay both halves. So that's why I call it the stealth tax. It's one of those things that you get to when you get to the tax day and you think you got your income tax under control, and it might be, you still might owe self-employed tax. Let's talk about the two types of income that's out there. There's active income and there's passive income. Active income is income that you earn when you do work. That's like realtor earnings, income from flips, income from wholesales. And there's passive income, which is income that you earn when your money's working for you. So it's stuff that you invest in. So that's interest income, dividend income, and it's also rental income. Now under the tax law, rental income is passive by definition. So if you're a full-time landlord, you're working your butt off managing all your properties, and you're working hard, but the IRS considers that passive income. And the cool thing about passive income is that it's not subject to SE tax. So part of the tax strategies I'm going to talk about is how you move stuff from active to passive so that you can lower your taxes. Let's talk about how income is taxed. If you're an employee, you earn wages, the government takes taxes out of it, and then you pay your expenses. If you're a business owner, you get revenues, you deduct your expenses, and you get taxed on the rest. So if you have lower net earnings, obviously you pay lower taxes. But because you get taxed on the bottom line, not the top line, business owners have an advantage in the tax code. So secret number one is start a business. It doesn't matter what you're doing, you need to have a business. Rental is a good way to get into business. So exploratory expenses, I have a lot of people that come to me and say, I've been spending a year figuring out if I want to get into this, and they spend a bunch of money going to maybe some coaching programs, buying a lot of books, doing a lot of stuff, buying different softwares and stuff like that. And then they decide they start a business. Well, the IRS considers all the expenses you spent before you start a business as exploratory expenses, and they're not deductible. Some of them can be capitalized, and they can be called startup expenses. However, if you set up that LLC And then you start spending money, guess what, that's a business expense now, because you're learning stuff to how to make your business grow. Before you didn't have a business, so the secret is getting that business started. And then businesses with losses every year are considered hobbies. So, question?
Yes, sir. You were saying once you start up the LLC, let's say I start up the LLC and then went somewhere and got some education and paid $10,000, but the business doesn't have any money yet.
It's going to, because you just went somewhere to figure out how to make more money, right?
Right, but do I have to, like, if I've got the 10 grand for the business expense, I have to give it to my company and then the company has a write-off for that?
Yeah, or your company reimburses you, but yeah, you would contribute the 10 grand, and then you reimburse yourself for the trip, or you pay for the trip for the company. And then you would have a loss. But the thing is, that strategy works great, but if you have losses every single year, the IRS starts wondering if it's a hobby or if it's a business. Because hobbies don't make any money, businesses do, yes.
How many years do they let you do that before they start
7?
questioning that?
Well, they look at 3 of the past 5 years. So if you have losses 3 years in a row, or you have losses, 3 in the last 5 years, they may consider it a hobby. So you have to make sure that you put some things in place so you can show that it's truly not a hobby, it's just a business, you just haven't made money yet. So one of those things is you need a business plan if you're gonna have losses. If you have a rental property, you have losses every year, they don't look at it because it's not an active business, it's an investment. They don't care whether you're losing money on your investments. You may not be able to deduct all those losses depending on your personal situation, but you can have a rental loss every single year and they don't really care. But if you have an active business, you're trying to write off stuff against your W-2 income, because that's what you can do with an active business. So that'd be a Schedule C business, for instance, or an LLC that's a single member. But that would be flipping and wholesaling. If you do that for several years and you haven't made any money, I'd have to question why are you in the business. But that's where they come up with, it's a hobby. It's like, okay. So the difference with hobbies is once they discover it's a hobby, you can't deduct any of those expenses. They go away and they go back and you pay tax on stuff that you thought you weren't paying tax on. Secret number 2 is once you have a business, you want to repurpose personal expenses into business expenses. An example of that is using like your cell phones. Everyone's got a cell phone, but as soon as you start a business, that cell phone is now a deductible expense if you're using it for your business. And we're all using it for our business. Now, if it's a part-time business, you may only be able to write off half of it. But if you're in the real estate business, your phone is blowing up all the time because you got all these marketing pieces out and sending stuff to it. You're using your phone. It's going to be deductible. Businesses must be customary and necessary. So, if you decide to open a business and take a trip to Greece, they might question whether or not that's customary or necessary. Now, if you go to Greece and you start buying properties over there, I would say, okay, that's a business expense. Then you also have to worry about Greece taxes, which I understand is really worse than the US. So the secret is whenever you spend any money, you need to get in the habit of start thinking, how is what I'm spending benefiting my business? Then it gives it a business purpose and you can now pay for it with your business as opposed to paying for it personally. Some examples of repurposing cell phones I talked about, vehicles used for business. In the real estate business, we're driving around all the time, even if you're just driving for dollars. Home office, you now get to write off a home office, and that's a great benefit because not only do you get to write off a portion of your house and expenses you spend against your business, you also get to count the mileage from your house to wherever you drive when you're going on business as if you're leaving from your office and you're going somewhere for business versus the first drive, the IRS considers it a commute until you get to work, and the first job you go to is work. But if your job is in your home, everywhere you drive can be business. If you take trips, obviously you go to different places and look for properties to buy, or you start marketing in Colorado. Meals, obviously meals for business. You take out clients, but also other people in the real estate business. Equipment and furniture that you buy, periodicals, if you subscribe to magazines, Realtors is a good one, or even real estate, but HGTV magazine, for instance, my wife gets that. And it's like, that's a business expense because I'm in the real estate business and we can use that to say we're looking at trends and all this other stuff going on. It becomes a business expense. Let's talk about vehicle expenses. This is one of your biggest expenses as a self-employed person. So especially as a real estate investor. So, you can actually you can deduct actual vehicle expenses or your mileage expense. But you have to track mileage either way, because you only get to write off the percentage of business use in your vehicle. And the IRS uses your mileage records to determine that if you get questioned by it. But mileage expense usually works out better for anyone anyway. So right now, gas is about $3 a gallon. If you drive a vehicle that goes 25 miles a gallon and you drove those 25 miles for business, you get a deduction for $14, but you're only out $3 in gas.
So what about the
there's
car
11
note?
bucks. I'm sorry?
What about the car note?
But that's what the mileage is supposed to have. The mileage is supposed to have in there your interest on it, the purchase of the vehicle or depreciation, either way you wanna look at it, all the repairs, everything. That's how they build it in. But they build the mileage rate off an average American car, which includes all the clunkers out there that still exist. So if you have a really efficient vehicle, that, you're gonna come up better on that. Now, the other thing that you can do is the actual expenses. So if you buy a vehicle that weighs more than 6,000 pounds, gross vehicle weight, actually it's
Yes.
rated at that, it has towing
Yes.
capacity carrying capacity. It's considered equipment. You can write that whole vehicle off when you purchase it, as long as you can claim that you're using 100% for business. If you're only using 85% for business, well, you get to write off 85% of it. And so the write-off is really depreciation expense. It's considered equipment under the tax code. And, so you get to write off it by accelerating your depreciation.
You can't do that at mileage though, right?
No,
One
you
of
can't.
the-
Once you write off the car, then you also have to use actual mileage, actual expenses after that point. 'Cause
So you can do it,
You
but
can write
it's
off
frowned upon when you get caught.
yeah,
You can write off the fuel though, right?
well, if you're using mileage for your deduction.
No.
But you can use actual expenses. So if you write off the truck, then yeah, your gas, the interest on the truck, any of the maintenance on the truck, you get to write all that stuff.
And that's just for year one, isn't year two
Yeah, any year.
on that vehicle, then it goes back to mileage?
No. Once you
No.
depreciate the vehicle 100% in the first year, you're required to use actual expenses, because you took accelerated depreciation on it. So
How often
you
then
s-
can you flip that to keep on taking advantage of that?
Well,
I
you
was
can
more
do it
like
every
2 or
year,
3
you
years.
can do it every year if you want. So I had a client years ago that did this is back when 1031 exchanges.
So we can buy a new vehicle like this year,
Yeah,
take the write-off this year, next year we can sell it and buy
Yes.
another one?
right,
And
and
do
you
it
get
again.
depreciation recapture on it when you sell it.
Right.
So you actually get
They won't-
taxed on, you gotta hold it for a long time until it's not worth much. Or you trade it in and then it's, right now the way it is, when you sell a vehicle for business, and if you depreciated it and you sell it for more than your adjusted basis, which is your cost minus depreciation, then you're gonna pay tax on that. And
Just
that's
like a house.
just
Yeah,
like a house.
just like-
Except it's a smaller thing.
Mhm.
But that's okay if you sell it and you pay depreciation on it, but you buy another vehicle, and then you have depreciation recapture on one hand, you have depreciation on the other. It's just net, and every year it's like depreciation arbitrage.
So literally, we could have an $80,000 write-off every year.
Yeah. By the
Well,
big
because
honking
you're
truck,
gonna-
yeah,
you're
you
gonna
got it.
But you gotta recapture what you sell though, right?
Right.
I mean,
Yeah.
But then you
won't-
do it again. Right?
Well, no, when you sell it though, when you sell
Right,
it,
so let's say you buy a $50,000 truck and you can write it all off, so you depreciate it $50,000 the first year. Next year you wanna upgrade and you buy a $75,000 truck, and you trade that $50,000 truck in, let's say you can get $40,000 for it after a year. So now you have $40,000 worth of depreciation recapture, but you have bought a new truck that you get a $75,000 deduction. So you still have a net overall deduction. And
Another 35. So
right,
now
so you only get
Right.
35 if you go up like that.
But the way cars are
Okay, so
right
you
now,
won't get
my
an 80
truck's worth
every
more
year.
than it was.
Yeah, I know, but right now with revenue.
Vehicles are worth,
Trucks
still
are
just gotta
more
keep
than-
buying.
Now's not the time to do that.
No.
I've got another question for you, Bob.
Sure.
Like the lady was saying about the vehicle, could you lease your vehicle to your company?
Yeah, but then you're paying income for lease income, so
Yeah,
it's
don't lease it.
moving money out of one pocket to another. But if you go and you lease a vehicle as opposed to buy it, you don't get the immediate write-off, but you may be able to write off, because you'll be able to write off the lease payment. But you still have the issue of, are you using 100% for business? then if you don't, if the company is leasing it versus you personally, then what happens is you also have to claim income for the part that's personal use. So it's like this convoluted calculation.
Okay.
Financially, leases don't work out
Yeah.
good anyway. Let's talk about how you track mileage. There's a simple manual method which you can write it down in your calendar every year, jot down how many miles you went for each appointment, add any extra appointments on it, print that out, total it up. At the end of the year, you got 52 pages with mileage on it. The easiest way to do is to get a mileage app. I use Mile IQ.
Yes.
I have Everlance. I used it last year, and I changed the slide to show Mile IQ. They were both the same cost. Everlance shut down, 1 month, and I don't have any miles for that month, so Mile IQ hadn't had a problem yet. Did you have a question?
I use Mile IQ as well. It's free if you have Microsoft 365. It's actually super easy. It's like getting on Tinder. You swipe left for person up, and you swipe
Everybody
And the cool thing about it, if you do a lot of repeat trips, it says, hey, you went to the same thing, you wanna classify it all as the same thing? Yep.
Yeah.
So now I have like
Automatic.
3 or 4 that I have to do every month. Although I have gotten on a plane and traveled somewhere and I get in and going, okay, I just drove from New Orleans to Austin.
Fastest drive.
It's tracking you wherever you are, so that's the interesting thing. But you gotta make sure that you print out your log every month. Now with Mile IQ, it sends you an email reminder, you wanna download it, and you just download them and save them. Because if you decide to stop using the service, or something happens, you have your database.
Up to date.
You know, you're gonna need it. All right, secret number 3, split your income into wages and profits to limit SE tax. Now, this is a strategy that I use a lot with realtors, but also use with all the rehabbers and wholesalers. This is where you set up an LLC when you get started in business, which I recommend to everybody. But then when your business takes off, you can then elect to be taxed as an S corp. And then S corp requires you to pay yourself a salary, but you have to pay you're required to pay yourself a reasonable salary. And so what that means is we try to figure out what a reasonable salary for your profession is, and make sure it's less than your income. And we have stuff to back up. So for instance, and then before you get to that reasonable salary level, there's really no reason to switch to an S corp. So for instance, rehabbers and wholesalers, pretty much are in the $50,000 to $60,000 a year range. So if you're making $300,000 a year as a wholesaler or rehabber, if you do this, you can save tax, SE tax on, $250,000 basically, because you don't have to. You're going to still pay income tax on it all. You're just not going to pay SE tax on it in addition to income tax. Realtors, this is a big deal because I have a lot of realtors that come to me. They'll get started, and as they're learning the business, things are a bit slow. But then all of a sudden, it'll take off. They'll have figured out the secret or gotten a few lucky breaks. Next thing you know, it's taken off. They come to me and it's like, I made a lot of money this year. What do I do? I was like, did you set up an LLC when you got started? No. I said, you're paying a lot of tax. There's nothing I can do. But let's set up that LLC now. Let's get started so that next year you won't be in this situation. If you're a landlord, this doesn't work because you don't pay SE tax. You don't even need to do that. So you want to have you want to have properties in your LLC, but you don't want to end up electing that LLC that owns property to be an S corp, because there's a lot of bad attributes that come around with having real estate within corporations. So let's talk about, we just went through this. So this is how it works. So the, now with S corp, if you elect to be taxed in S corp, you're still, and you have an LLC, you're still legally an LLC. So you get all the benefits of being an LLC. But the IRS looks at you as if you're a corporation. They treat you as a corporation, and specifically an S corporation, which stands for small business. And so the only rule that an S corporation has is you have to pay the owner a salary. And so there have been court cases that have been lost by mainly CPAs and tax attorneys who try not to pay themselves a salary and get away with it, and they lost every single argument. So it comes down to this, and this is one of the things the IRS is looking into more, is are S corp owners paying themselves reasonable salaries? And of course, the IRS thinks a reasonable salary is much more than you think is reasonable salary. Now, one thing when you set up entities, you want to avoid commingling of funds. What that means, and this is not really from a tax standpoint necessarily, this is more from a legal standpoint. Commingling of funds means you're using your business credit card or business debit card to pay for everything, all your expenses in your life. So you're paying groceries, you're paying your TV bill, you're doing all sorts of stuff on that. paying your kids' tuition, buying their clothes, whatever it might be. Because the money's in your business, you just need to move it out and use it for personal. And the problem with commingling it, there's not a tax issue because we can separate what's personal from business. The problem is, if you get sued, they want to go through that LLC to get to you and all your assets. And if you're commingling, you're not respecting the LLC and that entity, and that they can prove that to the court. Next thing you know, that liability protection is gone. So you want to make sure that you have that separated. And there's some simple things that you can do for that. It's like make sure that you're tracking your books separately. If you need to pay for some personal expenses, take a distribution out of your business, put it in your personal account, pay from your personal account. People get in trouble with this also with credit cards, because they'll have credit cards you're using for personal business, and they're writing a check out of the company to the credit card. And it's like, even though you're just paying off the business expenses for the credit card, you're still paying a personal credit card with the business. So if you use a personal credit card, because sometimes businesses can't get a credit card early on when they first start out, make sure it's exclusively used for the business. And then if it's not, you reimburse the business in personal use or something like that. Because I show up at the grocery store and I'll pull out the wrong damn card. I got a pocket full of them. I got 9 LLCs. You know, it's like, and my wife goes, "You use the company cards?" Oh, damn. And then we just transfer money back to the company, reimburse the company for that.
Hey, Bob.
Yeah.
So, for example, the credit card that I told you that I just got, that I pay everything on. So, if I have personal expenses and business on there, I pay the whole card with my personal account and then reimburse.
Yeah, and then you turn an expense report to each one of your companies for the expenses,
Okay.
which is basically every month you go
then
through and
we
highlight,
pay
or
back.
however you want to do it, and total up, this one comes from this company, this comes from this company, and you transfer the money out of the business account, your personal account, and you call it reimbursement of expenses, and
Okay.
keep a record of the credit card.
Got
So yeah, you can definitely do that. But as long as you're doing that kind of bookkeeping, you're not commingling at that point. All right, secret number 4, separate active business from passive business. So this is where a lot of wholesalers and flippers get in trouble, because they decide they come across something and they find a good property as a rental and they buy it in their LLC, but they've been doing all these flips. The problem is, which we'll get to in a little bit, is that when you're flipping properties or you're wholesaling properties, you're a dealer, because you're in the business of holding things for resale, and that's the definition. And so in the real estate business is the only business where we can inadvertently become a dealer under tax law. Because if you actually have a car dealership where everyone recognizes them, or they're a dealer, and they own the own building that they're in, that building's still considered real estate, still considered an investment for the business, even though they're using it for the business. So when they sell it, they can do a 1031 exchange, they can do an installment sale. But when you become a dealer in real estate, the real estate's considered your inventory, and if you mix it in the same entity, then what happens is the IRS can come in saying, "Oh, well, everything you do in this entity is a dealer. So therefore, you don't get to do the 1031 exchange, you don't get to do installment sales, and you don't get to do, you don't actually get to depreciate it." So you can rent your inventory. Go on. You had a question?
I was just gonna say, is there a magic number for the number of deals? I got popped on that one time in 2010, and it hurt. real
So
bad.
it's short of your active, so if you're just an individual and you do just a few deals a year, which is like you flip a house or something, you could maybe say that was an investment. And then, but if you start doing it a lot and there's a pattern of it a lot, you know, and I think it's like 4 or 5 deals a year, if you're doing that, you're gonna be considered a dealer at that point, because that's fairly frequent. So
I think I do
if you
like
start
that.
doing that, you wanna separate, you wanna own your rental properties in one activity, one LLC, and you want your flipper business, wholesaling business, whatever, in another one. And so I see this is a big problem when I'm talking to people all over the United States, and they don't realize that. The best entities for flipping and wholesaling we talked about before is LLCs, where you're allowed to be taxed as an S corp. That's after you get the income up and everything, because you want to separate the active income into wages and profits, and say that's you tax. But for rentals, you want to have it in LLCs, and you don't want to like to be taxed as an S corp. And the reason is, if you need to move that property out of that LLC, the only way to get it out, if you would like to be taxed as an S corp, is you have to sell it. And even if you claim it to yourself, that's considered a deemed sale, and you pay tax on the fair market value, the gain on the fair market value. And it's just a bad situation to get in. And then we talked a little bit about dealers
I'm sorry to
Yes.
interrupt the question. To clarify on the passive versus active, so if I have an LLC that only has rental houses and I'm not actively involved in real estate, which is like 50% of my time, that passive income is not subject to the self-employment tax,
No,
15%, right?
No, there's a
Even though it's
distinction there.
NLC.
So if you have a bunch of rentals, they're considered passive by definition of tax law. And even if you're actively managing them, they're still considered passive. You don't have to pay self-employment tax on them.
Right. Regardless of whether it's an LLC or a personal name?
Right.
Okay.
Yeah, it flows through to you and you get taxed on it, it's considered passive income. The downside of passive income, if you're not active in the real estate, is that you're limited on how much losses you can deduct,
Right.
if you have losses.
Right.
So usually in the first years that you're starting up and you're building a portfolio, you've got a lot of losses, because you're rehabbing houses, you've got a lot of depreciation, you've got a lot of mortgage interest. But as the tenants pay off your note, that mortgage interest goes down and your rents go up every year. So after a while, your rentals should be making plenty of cash flow, and you're being taxed on it, but you're only being taxed on it as passive income.
Mhm.
In the early years, you have the losses. If you have a W-2 job, and you and your wife have a W-2 job, and you make more than $150,000 a year, you don't get to deduct any of those passive losses in that current year, but they get suspended, and you get to use them later against your stuff. So where there's, which I don't think I go through in this, but there's a classification in the tax code called a real estate professional,
Right.
where that if you spend more than 750 hours working in real estate trades or investments, and you spend more than half your time working on your rentals in that, you can, and more of that, you spend, of any of the activities you do, you spend more than half your time on the rental part of it, the real estate part of it, you can be a real estate professional, which means your losses are unlimited against any other active income you have. So this works great if you have spouses, one of them is a real estate investor, the other one is making a huge salary, and then the real estate losses can offset that. And that's where you start using cost segregation studies, which is where you go, you buy a building, you analyze it, break it down into component parts. Some of those have short depreciation lives, and under the tax code, you can write them off the year you buy it. So you can buy a building, and, a big commercial building, $4 million, write off 50% of it if you can get the cost seg up there, and then so you get a $2 million write-off. But if you're not a real estate professional, you're limited to 25,000 of that write-off a year. And then, or if your income's above 150, you get no write-off that year. It carries forward and it will offset the income when you start making it later, but the idea is to write that sucker off against all the income you have outside of that.
I have
So-
one question.
Yes,
If you sell a property, how much time do you have in order not to pay taxes on that, income taxes for selling that property? Is that a year?
if you sell the property,
Like,
Yeah.
let's say
So
for
like a 1031?
100,000, yeah.
Like by.
Like, if you sold the property for $100,000, that's considered an income to you, right?
yes.
How much time do you have in order to buy a new property to avoid paying taxes on that income?
You pass that window, you don't get a chance. You gotta, it's called a 1031 exchange. You've gotta
Oh.
set that up and have that happen before. Once you go and close on the property, if you don't have it set up properly as a 1031 exchange, you're being taxed.
Yeah.
There is no time you can reinvest that in anything. So, for a 1031 exchange, that's where you basically trade the property for another property. And under a 1031 exchange, you have 180 days to reinvest the money in the property. You only have 45 days to identify the replacement property you're gonna buy, but you have 180 days to actually close on it. So, and then there's a bunch of rules around the 45 days and how many properties and what kind and all that stuff. So it's outside the scope of this discussion, but the key thing with an 1031 exchange is you've gotta hire an intermediary, a qualified intermediary, a company that specializes, focuses on doing that. They hold your cash until you buy the new property, they show up at closing, and then they give the title company the cash, and then they're an intermediary, so they're basically holding on to cash. But once you touch that cash, if you're in a 1031 exchange, so if you go to closing on the sell and you wanna keep 50,000 in cash out, you're being taxed on 50,000. And if you've had a building for a while and you've already done a cost segregation study on it, and you've depreciated a lot of it, that's all gonna be depreciation recapture, you're gonna pay at the highest tax rate, which is 25%. And if your marginal tax rate is at 37%, you're still saving taxes by doing depreciation recapture. But most of the guys I know in real estate just have a religious abhorrence to paying, aversion to paying tax. So some companies are considered dealers, developers, they're buying land, they're subdividing it, and then they're building houses on it. They're usually considered dealers, because that's the business that they're in. Construction companies, you know, basically anyone that's doing active businesses or, and they're turning over properties a lot. And then rehabbers and wholesalers. So there's a dealer trap though in real estate, and that's where, and this talks about for rental properties. So if you have, when we talked about a little bit, if you're flipping properties and you decide to buy a rental property in your LLC that flips, it might be stuck as a dealer property, and then when you sell it, it's gonna be SC taxed. But there's a big gotcha, which is subdivisions. So if you buy an acre of land and you subdivide it into 4 plots, then you may be okay, because there's a sort of a bright line ahead is 5. But if you buy a 10-acre piece of land and you subdivide it into 10 properties and you build a house on each one, you start renting them out, the IRS may come in, and then you start selling some of them later on, the IRS will come in saying, no, you're a dealer, because dealers are the only ones that subdivide land. So there's all these rules in that. And so if you bought the 10 acres, subdivided it in 10 houses, built the houses on there, and you rented it out for more than 10 years, then the tax courts have said, well, you're obviously a dealer, you held it for a long enough time. Then you can start selling those suckers. So you have to be careful. I had someone who did this, they bought some land in Tremay, and then they subdivided into 5 lots. 5 is the magic number, and they started building houses and selling them, and they wanted to take long-term capital gains on them because they owned it for more than a year. I said, no. You should have told me that, you know, what you were doing before you started doing all this stuff. Of course, they weren't a long-time client, it was sort of a new client. So what I like to do is create an entity that actually buys. If you know you're gonna do this, and you wanna hold some of the properties, you wanna sell some, you set up an entity it's in the business of buying land and subdividing land and selling lots. You have another entity that buys some of those lots. And then you can, of course, sell the other lots to anyone else. Doesn't matter that your company buys all the lots from it, builds the houses and sells them, and holds them for a period of time, and rents them out, and then sells them, because it's in the business of being a rental company. The other company is a dealer in land. And then you have to separate those two things.
And you said that the biggest deal for that is the dealers should be set up as an S corp.
Yeah, if you're
But
doing enough volume, yeah.
the renters
It's gonna be an
need to
LLC.
be just an LLC.
Yeah. Yeah, because because when you, there's a couple of things. So for instance, a lot of us, when we buy properties, we borrow money to buy it. And then rentals, we usually have losses in the beginning. But when you borrow money in an LLC, that debt you have is considered part of your investment, part of your basis. You're at risk for that debt. And then so you get to write off the losses that you have. Whereas when you're in a corporation, the corporation borrows money, you as the owner are not at risk for that debt. Then tax law has been, for a long time, sort of S corp sort of got caught up in that. Even though you're personally guaranteeing it, the IRS says until you put up the money, you're not at risk. And then, so what happens is if you have it in the S corp and you have a bunch of losses up front, you don't get to write off those losses. They get suspended because you're not at risk yet until you've paid down some of that debt. So there's a lot of really weird laws and really weird things that make corporations and S corp really bad for holding real estate. That's one of them. So that's just an example. So secret number 5, pay shared expenses with your active business. So we talked about splitting the businesses in 2. Now you got a flipper entity and you got a rental entity. Your flipper entity, you're gonna be paying higher taxes on because it's active income. Your rental entity, you're not gonna pay SC tax income. So you should, any shared expenses, because you're gonna have overhead, that you're gonna, you know, you're driving around your vehicle, you're gonna go to check on the rental properties and whatever, but you're also going and checking on your rehabs. You're gonna wanna allocate most of those overhead expenses towards your active business, because you wanna save as much money against that SC taxable income as you can. What you can't do is start paying your rental interest and property tax and all that out of your active business. That's gotta come out of the entity that does that. But overhead expenses, your cell phone, any marketing you do, whatever, that should basically be under your SC tax ones. Now, as long as these are shared expenses, if you're spending something specifically for your rental, it gets hard to argue that it was for the other business too. So, and, so someone say,
Yes, sir.
yeah, Eric?
If you had a piece of land, I've got a piece of land I've owned for years, just subdivided it, I wanna stick some mobile homes on it and sell it. Now, I've had it for more than a year a day, am I gonna,
How many parcels did you create?
two,
Okay, you're good.
so I won't,
Just don't do another two next year, and another two the next year, and then you start showing a pattern that you're actually in the business of subdividing something. So,
What do you subdivide a lease purchase for a 10-year note?
you're good.
Okay.
Yeah, as long as you own it for that 10-year period, you're good.
Gotcha.
So property management, here's something that happens all the time. Someone, they're a landlord, and they decide to set up a property management company, which is okay, there's nothing wrong with that. But if they're only managing their own properties, there's no reason to actually charge your rentals a property management fee, because you're moving it from passive to active income, and you pay SE tax on that. Now, if you have a bunch of LLCs with a bunch of rentals, and you create an LLC that manages those, and it's for where all the overhead goes, and you're just really using it to allocate expenses, that's okay. The idea is the property management company breaks even. But so many people are like, no, I wanna pay myself a salary so I can get a loan. I says, well, you're gonna pay SE tax on income you didn't have to, and number one, that doesn't work because the bank sees right through that. If you're the owner of the company and you pay yourself a salary, the bank doesn't care, because they wanna know what your business is doing, not how much your salary is. So, that whole strategy doesn't work. So if you're in the business of property management and you're managing properties for other people, that's when you want to set up a property management company. Now, with that being said, it is a good idea if you're a professional landlord and you don't want to be known as the landlord. So when you're talking with a tenant, you want to be able to Louisiana, you pay $35 a year to maintain your LLC. It's disregarded. That's what you use the property management company for, but you're not running any expenses through it. It's just an entity you can use as a facade to say that I'm not the owner. And of course, you can always defer to your wife. She's making all the decisions anyway. So,
she makes them anyway.
all right, secret number 7, shift active income to passive income. This is where, if you change the nature of the business, so if you have an active business and you're in a flipping business, say, and you're gonna pay SE tax, but if you could somehow manage to get that property considered to be a rental, a passive thing, you're gonna now get the benefits of it being a passive, entity, including long-term capital gains if you hold it long enough. So so this is one way where when you're in the flipping business, you come across a property that's gonna make a huge gain, and it would make a great rental. You don't buy it in your flipper entity, you buy it in your holding entity, and then you lease it with an option to purchase it after a period of time, and once you get past a year and a day, you can sell that sucker, and it's considered a long-term capital gain. As opposed to selling it immediately at 30 to 60, 90 days later and paying self-employment tax on it. The other thing is to, I have rent real estate in your active business. So if you have an active business and you also own a commercial building, you can rent space from yourself if you wanted to do that. This is how most businesses are set up. They're brick and mortar businesses. They buy their building, they have to operate like a doctor's office. They own the building, they have their office in there. They rent the building from themselves, so they get a deduction from the self-employment income, and they get to have the passive income. Plus, if they're losing money on some of their other rental properties because they're writing off cost segs, they can shelter all their rental income because it's passive income. Or some of it, I should say, because that's considered self-rental. But the key here is to take your flips and make sure that you convert them into rentals. And I see this a lot with guys doing land, because they sit there and they're flipping them, and because on a land flip, you can do this on houses too, but it's real common on land. So you buy a plot of land and you pay $3,000 for it. You find someone that wants to pay 10 for it, and you basically say, okay, I'll take $3,000 down and I'll finance it for you for however many periods of years at a low interest rate. And so now they create a cash flow stream, and they've gotten all their money back, so they can go and repeat that. Well, the problem is they're a dealer because they're wholesaling land, and so unless they separate that up in a separate entity and they set up some structure so that they can show that they're actually in the rental business, then and they're not just flipping stuff, they can save that tax. One of the things I recommend for that is if you use a lease as opposed to any other form of selling property, a lease is a rental. It's got it in the contract. That's what it is. You just set up a lease and you give them the option to buy it, and it's a structure. Because leases, when you think about it, is just a financing mechanism. It's nothing different than anything else. It's just the terms you have in the contract. And then there's some benefits to having a lease versus having a mortgage, because you can foreclose as opposed to, you can evict as opposed to foreclose. But you got to think about those things when you're buying, so you can set up, how do I set up so I have it as tax advantage as possible. Secret number 7 is use a system for tracking your business and personal expenses. I was talking to Dina earlier and said that I still have clients that come in and bring me their boxes of receipts. And it's like, they have no idea how much money they've spent during the year, other than they know they've only got $5,000 in their checking account and they made $150,000. They're not sure where they spent it all. And it's like, and so I gotta dig through the receipts and tell them where they spent it all. But if you really want to grow your business, you need a system where you're tracking your expenses and you're tracking your income, because you want to see where you're going. You want to make sure you're on track. You want to make sure you're profitable on your projects. And the only way to do that is having some sort of system that you can use for tracking your expenses. You also want to make sure you deduct every eligible expense, because if you're not really tracking your expenses very well, you're going to miss deductions because you just didn't remember you had the expense. You don't have the receipt anymore. You don't remember what that transaction is on the bank statement, especially if you're paying for stuff in your personal expenses, and you can get reimbursed from your company, but if you don't remember what you spent the money on, you have that. So the benefits of bookkeeping is basically, you don't miss an expense. You can calculate your income during the year, make sure you're on track. You can also compare your income and expenses to the same period prior years, to see how you're growing your business. And then you make better business decisions because you know your profitability. You can use different softwares for that. There's a bunch of different ones depending on what kind of business you're in. The key to success with using any kind of software is that they all have a bank reconciliation function. You have to use that, which basically means you go through, key in your ending bank balance, and check off all the transactions that cleared. Most people look at the bank balance on the computer and then at the bank and like, yep. No, that's not reconciling. You're going to miss transactions, especially if you're downloading stuff in the background. I've seen that happen too many times. I've also seen, everyone's taking mobile pictures of the checks and depositing checks. Those go through the bank several times, so just be careful. Someone hangs onto it 3 months, takes a picture again, it's going to show up on the bank statement. It had to happen for several clients. So if you're reconciling, you're going to find that. You call the bank and say, this cleared 3 months ago, but they give you your money back. But if you don't ever call them and ask them, they don't know because they're not tracking it. So some software recommendations. QuickBooks is sort of a standard. It's out there a lot, and it's a pretty basic accounting package. Mint.com, if you're doing personal transactions, that's for tracking your own personal stuff, but you can also set up codes in it. Mint.com is free so far. QuickBooks, they charge a monthly fee for residential rentals. Stessa.com, it's free, it's really good, but it's really simple. So it's really good for tracking your income and expense by rental, but you have to upgrade to something like Buildium or Appfolio to be able to have portals for your tenants to log in and track everything and really keep track of your tenants. So, but this is, when you're just getting started, you got one rental, Stessa, use it, it's good. All right, secret number 8, don't sell all your real estate. I started telling people, I paraphrase Yoda. It's like, buy or buy not, there is no sell. It's like, you gotta keep the things. The only way you can grow your wealth is you gotta have real estate that's growing with you. If you're flipping properties, that's okay, you're earning current income, but you're not building any wealth. So you gotta keep a few of them. So when you come across a property that's gonna be a really good investment, a long-term hold, keep that sucker. Especially if you're getting a really good deal, you got a lot of equity in it, you can use it for other things like borrowing against it to buy other properties and stuff like that, and it's gonna grow over time. The wealthiest people that I know, own real estate. And when landlords retire, their income doesn't go down. Instead, it continues to increase every year. So I've had guys that when they were younger, they were socking away all this money in their IRA, and it was a traditional to save taxes. And they hit the magic age when you have to start pulling money out, which used to be 70.5, is now 72. And all of a sudden, they jumped up to a higher tax bracket, and they're paying way more tax on the money pulling it out than they ever saved putting it in there, because they started buying rentals when they were in their middle years, and then next thing you know, they've got all this income, and it didn't really save them. So that's why you should have a Roth, by the way. Anyway, you can generate cash flow and have tax losses, that's depreciation. And, you know, keep the stuff. Secret number 9, make tax planning part of your routine. Some of these strategies we talk about is like, there's strategy to it. And there's things you have to do beforehand to make sure that it works. So you always want to be thinking about what the tax effects are on the decision you make. Because remember, we started out this like, taxes is one of your largest expenses. It's a business expense. Most people don't think of it as a business expense because they don't put any forethought in it. It's an afterthought. Oh crap, how much tax am I owing this? Well, when you go into investment, you should actually know that before. And then you can talk about, okay, how do I structure this so that I save as much tax as possible? And that's some of the ideas that we've talked about tonight. Always discuss major purchases with your tax advisor. And once you've gotten beyond, if you're making the same sort of purchase and everything, like you're buying an apartment complex, you're buying a rental property or whatever, you want to make sure you set it up the right way. Once you've done so, when you've had that conversation several times, you know how to set it up and how your tax advisor is going to advise you. But when you're first starting out, you should be having that conversation as often as you can. And you want to meet with your tax advisor more than just once a year at tax time. So November and December for me was really busy because I had everyone calling up saying, we got to have a strategy session. Let me tell you what I did this year and tell me how I screwed up and what can we do to fix it before the end of the year. I have that conversation every year. There's tax avoidance, which is where you implement a strategy to make sure you pay the lowest amount of tax. And there's tax evasion, where you change the situation afterwards and, oh crap, I should have done this. Well, let's change the documents and let's do it this way, or let's call it this. Tax evasion is illegal, you go to jail for that. Tax avoidance is perfectly legal. That's what I get paid to do. So you want to make sure that you're doing things the legal way, which means you're making the decision before you have the transaction. Secret number 10, work with an entrepreneurial CPA. So as someone has an entrepreneurial spirit, they're growth oriented. When you come to them with an idea like, I have an idea for doing this, they don't say, oh no, you don't want that, that's too risky. They sit there and want to tell me more about it, let's look at this stuff, let's run some numbers, let's have some ideas. They provide proactive and efficient service. One of the things that we do in this month, because we're talking about how busy January was. Well, I discovered years ago when I was working for another CPA firm, entrepreneurs set up LLCs all the time, and they don't tell their tax advisor. And then they drop off their stuff 2 days before the tax deadline on April 15th. Well, then they set up LLCs and they were due a month ago. And we didn't file an extension. Now you're gonna have all these penalties for all these things. So one of the things we do in our firm is we look up everyone in the Secretary of State in every state that they're in, that we know that they're in. And then we find out, oh, they got a new LLC, let's find out what they're doing. And that's another way I can have a conversation with them, but then we find out. But it's just real simple. And when in doubt, file an extension, and then it finds out you don't have to file a tax return, no one cares. They also invest in real estate. There's a lot of tax preparers out there, a lot of CPAs out there that don't invest in real estate other than their own home. And that they haven't done enough transactions to know how everything works. And so when you go to them and you ask them something, especially something creative like we do in this room, they don't have any idea what you're talking about. And in some cases, if you try to explain to them wholesaling what you're doing, they're going to say, that's illegal. No, it's not. So, and they also use the same tax strategies that they recommend. So So I just described myself, by the way, which y'all already figured out. So that's basically the presentation. So I have some of these things here. And if you want to get a free copy of the slides, text investor to 95244-3944. And I'll be happy to answer any questions you guys have. Yes?
When you buy a property, say late in the year, do you get the full year credit for depreciation, or do you have to sort of prorate it to the amount of time you own the property?
So real estate is on a straight line method, so that means that if you buy it in December, you only get to depreciate it for the month of December. But if you buy the property, you do a cost segregation study and break it down into the equipment you can write off when you purchase it. So you can buy, like we were talking about the vehicles earlier, you can buy a vehicle on the last day of the year. In fact, you can show up at the dealership, sign your name, not even write a check or anything, and drive off the lot. You just finance it 100%. And as long as everywhere you drive is for business purpose, you can write that sucker off 100%. Because you documented it the only time you wrote. Now, the next year you may not be doing that much percentage, but you already have to write off this year. So I had a client that did that strategy, bought 2 days before, and then most of the mileage was deductible, so we have to do that.
Is it cost segregation worth it in every case, or just like bigger properties?
Usually it's better on bigger properties. So if you have a single family residence, you're gonna get a tax deduction, but it may not be worth the cost of it may not offset the cost of it.
Okay.
So, I like to think of like a fourplex or larger, because you're usually talking bigger. Yep. And, so the bigger buildings is definitely.
With the hurricane, just kind of prepares that.
If you come across any,
Yeah, so Eric just asked about, I have a casualty loss. So casualty loss took place, the loss took place from the hurricane. So even though you spent the money today, you get to write it off last. And then basically with casualty losses, the money that you spend on the property, with a business you have, you get to write off expenses anyway, so the repairs and everything. But some repairs have to be capitalized. But when you're doing the repairs because of a casualty loss, you get to write it off all in that year. And it does show up on a separate form, but you get to deduct it in that year, less if you got any insurance proceeds for it. So say if you had a $30,000 loss on a property and you got $10,000 from the insurance, you got a $20,000 write-off for that year. And then, but it's limited by how much basis you have. So if you have a property that's fully depreciated, of course you're investing the money in, you're replacing whatever was lost. So you basically, it goes back down to zero. So you get to write off everything you spent over the insurance. So I was talking, I think a few months ago we talked about this, but back during Katrina, I was working for a CPA firm, and there was a client that owned a bunch of commercial buildings around New Orleans. And of course, after the storm, because it was in New Orleans, and some of them were flooded, and they were not being used. And a commercial building is the value of a commercial building is based on the rents that you get from it. And so what happens is, the way that casualty loss rules are written, you get to write off up to the loss in fair market value. And then, he lost everything on the building with the cost, and he went down and he got it appraised, and the appraisal's done. And so he had millions of dollars worth of losses that he took in 2005 when Katrina hit. And I worked with that firm for about 10 years, and he was still living off of the fact that he paid no tax after that because he had these losses that kept going every single year. Now, he would have some self-employment income, he'd pay tax on that in a few things, but he didn't anything because he had these huge losses. So there's an opportunity to do that this year too. So if you have a bigger building, then it may be worth to hire an appraiser to come in and say, what was it worth the day before the storm, and what was it worth after the storm, especially with a commercial building, because it's now rents went to zero. I'm not being able to rent out, especially in your La Place.
Would a fourplex count as it?
Yeah, any building would do it. So I had a client that had, now this was for Zeta, which was the year before, but he had a property in in past Christiane, right on the bay over there, and it came across from Bay St. Louis. It came through and, you know, insurance didn't pay him hardly anything, even though he had all the stuff on there, but because they had this high wind and hail deductible, you know, he had a huge write-off, and it was a rental property. So it's like, he got to write off a big chunk. So yes, it can, and that was a single-family home, that was a bigger single-family home, but still, yeah, you can do it on anything. It's, key is the value of the home and how much the value is, you know. And then some places, even single-family homes, there might be areas, like there's probably a lot of people that do not wanna buy in LaPlace right now. So that means the market is depressed, the houses are,
Yeah.
the real estate value has gone down. Or appraiser can come in and say, well, before the storm hit, they were selling at record prices, and it was worth this value, but then after the hurricane hit and all the flooding and everything, no one wants to live there. So it's not only is the price down because of their damage or whatever, it's also the market is now depressed, and they value that, and Irish will accept it because you got the appraisals that we see different times. Any other questions? All right, well, thanks, guys.